The quote, "If you find yourself in a hole, stop digging," is a simple yet powerful piece of advice often cited in the world of investing. Its popularity stems from the straightforward logic it conveys. When facing a problem, continuing the same actions that caused it will only make matters worse. In investing, this wisdom is especially relevant as it encourages individuals to recognize losses and avoid compounding mistakes by stubbornly holding on to failing strategies. The phrase resonates because it embodies common sense. Sometimes, the best course of action is to pause, reassess, and prevent further damage. Over time, this quote has become a staple in financial discussions, reminding investors to act rationally rather than emotionally. Its enduring appeal lies in its universal applicability to both financial decisions and everyday life. It's important to consider whether the advice being offered could actually be a trap for investors. During market downturns, following certain recommendations without careful analysis may lead to significant financial losses. Some strategies that appear promising in stable conditions can quickly become risky when markets are volatile. Investors who rely too heavily on popular tips or trends may find themselves exposed to unexpected downturns. Recognizing the potential for costly mistakes is crucial, especially when emotions run high and decision-making becomes pressured. By questioning the reliability of advice and understanding the risks involved, investors can better protect themselves from falling into common pitfalls. Fear often plays a significant role in shaping investor behavior, especially when a quote or market signal is misunderstood. When investors misinterpret information, it can trigger anxiety and lead to hasty decisions. This panic frequently results in selling assets during market downturns, which is typically the least advantageous time to exit. Such reactions are driven more by emotion than by careful analysis, causing investors to lock in losses rather than wait for potential recovery. Understanding the true meaning behind market signals and quotes is essential to avoid falling into this trap. By maintaining a rational perspective, investors can make more informed choices and potentially safeguard their investments from unnecessary harm. Warren Buffett and Charlie Munger are renowned for their practical wisdom, often sharing advice rooted in real-world experience. When they caution against digging yourself into a hole, it's important to recognize the context in which they speak. Their guidance typically refers to financial or business missteps, such as making poor investments or taking on unnecessary risks. Understanding the specific hole they mention helps clarify the nature of the problem, whether it's a financial setback, a strategic error, or a lapse in judgment. By grasping the original intent behind their words, we can apply their advice more effectively to our own decisions. This nuanced perspective ensures that we don't misinterpret their guidance or overlook its relevance to our unique situations. The phrase "stop digging" is often cited by financial media and investors as a universal rule for selling investments that have declined in value. This simplistic approach suggests that once an asset starts losing money, the best course of action is to sell immediately to prevent further losses. However, this interpretation overlooks the complexity of financial markets and individual investment strategies. Not all declines signal a permanent problem. Some may be temporary setbacks or part of normal market fluctuations. By treating "stop digging" as an absolute rule, investors risk making hasty decisions that could undermine long-term growth. It's important to consider the underlying reasons for a decline and to evaluate whether holding or selling aligns with one's broader financial goals. Blindly following this rule can lead to missed opportunities and unnecessary losses. The phrase "stop digging" is often used among traders as a way to justify cutting losses and exiting positions before they might recover. It originates from the saying, "If you find yourself in a hole, stop digging," implying that continuing with a losing trade could make matters worse. While this mindset can help prevent further losses, it may also lead to premature exits that miss potential rebounds. Traders sometimes use "stop digging" as an excuse, rather than a strategic decision, to avoid the discomfort of holding on to a losing position. Understanding when to apply this principle requires careful analysis rather than relying solely on emotion or fear. Ultimately, the phrase reflects the delicate balance between risk management and patience in trading. Short-term trading strategies focus on capitalizing on rapid price movements, often within days or even hours. Traders closely monitor market trends and technical indicators, aiming to profit from volatility. In contrast, long-term investing is centered around holding assets for extended periods, allowing investments to grow through compounding and market appreciation. Adopting a trader mentality as an investor can be detrimental, as it may lead to impulsive decisions and frequent portfolio changes. This behavior often results in higher transaction costs and increased emotional stress. Investors who shift away from their long-term plans risk missing out on the benefits of patience and disciplined growth. Understanding these differences is crucial for aligning financial strategies with personal goals. Consider a situation where an investor faces a sudden market downturn. Overwhelmed by fear and uncertainty, they decide to sell their high-quality assets, hoping to avoid further losses. However, this reaction often leads to locking in losses, as the assets are sold at depressed prices. The investor misinterprets the advice to do something during turbulent times, acting hastily rather than thoughtfully. Instead of weathering the volatility and allowing the assets time to recover, they exit their positions prematurely. This scenario highlights the risk of misapplying investment wisdom and underscores the importance of maintaining discipline, especially when emotions run high. The sunk cost fallacy is a common psychological trap where individuals continue investing in a project simply because they have already committed significant resources, even when future prospects look bleak. Warren Buffett cautions against this tendency, emphasizing that past investments should not dictate current decisions. His advice is particularly relevant when dealing with failed projects rather than reacting to short-term market fluctuations. By recognizing when a project is no longer viable and being willing to walk away despite previous expenditures, investors can avoid deepening their losses. Buffett's approach encourages rational evaluation, focusing on future potential rather than emotional attachment to sunk costs. The second type of hole refers to a business that is fundamentally broken, often due to structural flaws or irreversible market shifts. These companies face challenges that go beyond temporary setbacks, making recovery extremely difficult or even impossible. For example, Berkshire Hathaway's original textile mill struggled for years against cheaper foreign competition and technological changes, leading to its eventual demise. Similarly, Blockbuster Video failed to adapt to the rise of digital streaming, leaving it unable to compete with new market leaders like Netflix. In both cases, the core business model was no longer viable, illustrating how some companies find themselves in holes too deep to escape. It is important to recognize the difference between a temporary decline in a stock's price and a lasting loss of capital resulting from a fundamentally broken business thesis. A short-term price drop may occur due to market volatility, external events, or investor sentiment, but the underlying value of the business can remain intact. In contrast, a permanent impairment happens when the core assumptions about a company's future prospects prove incorrect, such as deteriorating competitive advantages or unsustainable business models. This distinction matters because temporary setbacks can often recover, while permanent impairments may lead to enduring losses. Understanding this difference helps investors make more informed decisions and avoid reacting impulsively to market fluctuations. During market crashes, emotions often run high and decision-making can become clouded. The phrase, "stop digging," is commonly used to advise investors to halt actions that may worsen their situation. However, Misinterpreting this advice can have serious consequences. Some may believe it means to immediately sell off their investments, locking in losses that could have been temporary. Others might ignore the warning and continue risky behaviors, deepening their financial troubles. The true aha moment comes when investors realize that sometimes doing nothing is the wisest course. Understanding when to pause and reassess can prevent irreversible mistakes and help preserve long-term financial health. This quote, when misused, can become a powerful tool for fear. In times of market turmoil, it may give investors a false sense of certainty, convincing them that selling during a downturn is the safest option. Acting on this fear often leads to selling at the lowest point, just before markets begin to recover. As a result, investors may lock in losses and miss out on the subsequent gains. The psychological impact of such decisions can reinforce a cycle of anxiety and poor timing. It's important to recognize how fear can distort rational judgment, especially when influential quotes are taken out of context. During market downturns, investors often face the temptation to sell their holdings in response to falling prices. While this may seem like a way to limit losses, selling high-quality assets at a low point can actually lock in those losses permanently. What was once a temporary decline on paper becomes a real financial setback when the asset is sold. High-quality investments typically have the potential to recover over time, but selling them during a downturn removes any chance of benefiting from future rebounds. This approach transforms what could have been a short-term fluctuation into a lasting loss, underscoring the importance of patience and long-term perspective in investing. The prudent investor's approach centers on safeguarding capital and maintaining a sense of security, rather than being swayed by daily market fluctuations. Instead of chasing trends or reacting impulsively to price changes, this strategy emphasizes careful analysis and understanding of each investment's fundamentals. By prioritizing a thorough diagnosis of opportunities and risks, investors can make decisions based on sound reasoning. This method fosters peace of mind, as choices are guided by logic and long-term objectives, not short-term volatility. Ultimately, the prudent investor seeks stability and sustainable growth, valuing patience and discipline above speculation. During periods of market decline, investors face uncertainty and must make critical decisions. Two essential diagnostic questions can help guide their approach. First, is the business itself fundamentally broken? This involves assessing whether the company's core operations, financial health, or long-term prospects have deteriorated. Second, is the market simply reacting out of fear? Sometimes, widespread panic can drive prices down even when businesses remain strong. Distinguishing between these scenarios allows investors to make more informed choices, separating temporary market sentiment from genuine business challenges. It's important to recognize that the decision to stop pursuing a business or investment should not be made lightly. The appropriate time to stop digging is when the underlying thesis, the core reason for believing in the opportunity, has fundamentally failed. This means that new evidence or changing circumstances have invalidated the original assumptions that supported the venture. Temporary setbacks, market fluctuations, or operational challenges are not sufficient reasons to abandon a project if the fundamental thesis remains intact. Only when it becomes clear that the foundational logic no longer holds should one consider stepping away. This disciplined approach helps avoid premature exits and ensures that decisions are based on sound reasoning rather than emotion or short-term difficulties. During times of market panic, it's natural for investors to feel uncertain and consider selling their holdings. However, if the underlying business remains fundamentally strong, holding, or even buying more, can be a wise decision. Market downturns often lead to temporary price drops that don't reflect the true value of solid companies. By maintaining confidence in the business's long-term prospects, investors can take advantage of lower prices to increase their positions. Historically, those who stay invested during turbulent periods often benefit when markets recover. This approach requires patience and a clear understanding of the company's fundamentals, but it can lead to significant rewards over time. The key lesson here is to recognize the nature of the challenges you face. Understanding whether a setback is temporary or more serious allows you to respond appropriately. By staying aware, you can prevent short-term difficulties from becoming lasting problems. It's important not to let momentary obstacles define your long-term outcomes. With careful consideration, you can navigate setbacks and avoid decisions that turn minor issues into major losses. As you consider your own approach to investing, take a moment to reflect on the rules and principles that guide your decisions. Everyone's journey is unique, shaped by personal experiences and lessons learned along the way. Sharing your insights and strategies can help others navigate the complexities of the financial world. By contributing your wisdom in the comments, you help foster a supportive community of thoughtful, prudent investors. Together, we can learn from one another and build a foundation for smarter, more confident investing. In summary, while popular investing advice can offer quick tips, it is a deep understanding of financial principles that truly empowers informed decision-making. Relying solely on catchy quotes or trends may overlook the complexities and nuances of successful investing. By critically examining the origins and validity of common advice, investors can build a more resilient strategy. Your insights and curiosity are valuable. So if there are other investing quotes you'd like to see explored in depth, feel free to share your suggestions. Together, we can continue to uncover the real lessons behind the words that shape our financial thinking.